Imagine waking up, grabbing your phone, and realizing you are legally obligated to take physical delivery of like 10,000 barrels of crude oil right in the lobby of your apartment building by noon.
Yeah, good luck explaining that to the doorman. I mean, it would be a total nightmare.
Right. But today, we're diving into the hidden financial engine, where one missed click on a trading screen could, theoretically, make that actually happen.
Which is wild to think about.
It really is. Welcome to this deep dive into our source material, the architecture of commodity markets and price discovery. Our mission for you today is to demystify this, completely invisible, entirely ruthless market that dictates the cost of your everyday life.
Yeah, because from the price of your morning coffee to the gas in your car, it's all decided here. We're going to look under the hood to see who actually pulls the string.
Exactly. Okay, let's unpack this, because to really get our heads around this system, I like to think of commodities as the fundamental source code of the global economy.
Oh, I like that. Source code.
Yeah, like before you have the slick software or the beautiful user interface of a finished product like, a cotton shirt or a cup of espresso, you have the raw, unfiltered code, the dirt, the metal, the plants.
Right, the physical building blocks, which is why we have to start by looking at, well, the oldest form of large-scale economic organization we have.
I'm talking ancient history here.
We are. To really understand the complex financial engineering happening on Wall Street today, you have to realize that trading commodities predates the concept of a stock market by centuries.
Decades before anyone even thought of a bond, right?
Oh, centuries before.
Yeah.
The core mechanics of this market, they trace all the way back to merchants meeting along ancient trade routes, like the Silk Road. They were exchanging agricultural products, craft materials, just, the basic necessities of life.
Wait, hold on. If we are talking about ancient merchants trading silk and grain, why does this specific market have such an intimidating high-stakes reputation today? I mean, if it is literally just raw materials pulled out of the ground or grown in the dirt, why does a Wall Street bank in a glass tower even care? Shouldn't the price of grain just be a private negotiation between the farmer and the bakery?
You'd think so, but that assumes the farmer and the bakery operate in a vacuum, which, they don't.
Right.
The reason Wall Street cares so deeply about dirt and mining is because controlling or predicting the cost of those foundational building blocks means you hold the key to predicting the profitability of almost every other sector on Earth.
Ah, so it's a ripple effect.
Exactly. It's the lead domino. If an investment bank knows exactly what copper is going to cost 6 months from now, they can predict the profit margins of tech companies, housing developers, auto manufacturers.
So predicting profitability means Wall Street has to categorize these completely different materials because you're lumping like oil, gold, and wheat into the same overarching commodities bucket.
Yeah, which sounds messy.
It does. How does the market actually structure these completely different beasts?
So, the source text breaks the commodities world down into a few distinct categories based on their physical realities. First, you have energy.
Okay.
This is the literal fuel of the global machine. Oil, natural gas, gasoline. Second, you have metals. This includes precious metals like gold, but crucially, it also includes industrial workhorses like silver and copper.
Which are required for like electronics and infrastructure.
Right, the stuff running your smartphone.
And then we get into the biological stuff, the things that are actually alive.
Yes, so the livestock category encompasses live animals, primarily hogs and cattle. And finally, you have the agricultural, or what the industry calls soft commodities.
Soft commodities, I've heard that term.
Yeah, that includes crops grown in the ground like corn, soybeans, and wheat, alongside cash crops like cotton, coffee, and rice. What's fascinating here is how the physical logistics of storing these different categories completely alters their financial behavior.
How so?
Well, you're putting them under one financial umbrella, but the mechanics of managing them are just worlds apart.
I actually want to focus on that storage mechanism for a second, because that really highlights how bizarre this market is.
It really is bizarre.
Right. Because if you invest in a stock, it just sits in a digital brokerage account. It doesn't do anything. But physical commodities have a literal shelf life. It's almost like trying to manage the logistics for completely different types of movie productions.
Oh, that's an interesting way to look at it.
Yeah, like gold is like owning the master reel of a classic film.
Yeah.
You lock it in a climate-controlled vault, it sits there doing nothing, and it theoretically just accrues value over decades. I mean, it doesn't need to eat.
No, it just sits there.
Yeah.
And compare that vault to the livestock category.
Right. Livestock is like funding a live theatrical performance with a cast of child actors.
Wow, yeah, that's surprisingly accurate.
They are constantly growing. You have to feed them every single day, house them, keep them healthy, and there's a very strict, immovable window of time where they are actually ready for the stage. If you miss that window, the whole investment is ruined.
Exactly. That physical burden of storage,
Yeah.
the literal cost of feeding a herd of cattle versus the cheapness of leaving a bar of gold in a safe
Yeah.
is priced directly into the financial contracts traded in Chicago and London.
And then, of course, you have the soft commodities,
Right.
which are basically the outdoor indie film shoots.
Totally at the mercy of the elements.
Entirely dependent on the weather, completely unpredictable, where one unexpected rainstorm can just wipe out the entire production budget.
Which brings us to the core mechanism of how these different materials are actually valued. Because prices in this arena are not dictated by some monopoly.
Right.
There isn't a CEO of commodities sitting in a boardroom fixing the global price of a bushel of corn. The boardroom is actually millions of independent, brutal decisions happening simultaneously.
Driven by supply and demand.
Exactly. The absolute laws of supply and demand.
But, the textbook supply and demand explanation always feels a bit abstract to me. Like, we know that summer driving season means more demand for gas, so the price goes up at the pump. We get that.
Right.
But the source text gets into the specific violent ripple effects of supply shocks, especially with weather.
Yeah, let's use a very specific scenario from the text to illustrate that mechanism.
Oh.
Because it's not abstract at all. Imagine a freak, severe frost hits a major coffee-producing region in Brazil.
Okay.
The demand hasn't changed. Millions of people around the world still desperately want their morning espresso. But that frost instantly, physically destroys a massive percentage of the global supply.
So the price immediately spikes. But how does that actually impact a local business, like, say, a mid-sized coffee roaster in Seattle?
Well, that local roaster in Seattle is suddenly thrown into a panic. They had budgeted a very specific amount for their raw beans for the entire year.
Right.
With the Brazilian supply wiped out, they have to scramble to find beans elsewhere.
Like Colombia or Vietnam?
Right. And that
Yeah.
sudden rush of desperate buyers floods the market for Colombian beans, creating a contagion effect that drives that price up too.
Oh, wow.
So the Seattle roasters' profit margins evaporate overnight. They either have to absorb the massive loss, which could bankrupt them, or they have to pass that cost onto you, the listener, doubling the price of your morning latte.
It's just a stark reminder that the inflation we feel at the grocery store isn't always just abstract corporate greed or currency fluctuation.
No, not at all.
A lot of the time, we're literally just paying the financial penalty for a bad storm that happens 6,000 miles away.
Exactly. And because weather, geopolitics, and demand are shifting on an hourly basis, the market cannot function with just one universal price for a commodity. It'd be impossible.
So what do they do?
To handle the chaos, the financial system created two entirely different pricing timelines. You have the spot price and the futures price.
Two timelines. I love this concept. Let's break down the mechanics.
The spot price is the simplest to understand. It is the literal cash price for a physical commodity today, right now. The text uses a great straightforward example. Let's say an oil refiner has empty tanks and needs crude oil immediately. They go to an oil producer, buy 10,000 barrels of oil for $50 per barrel, and take immediate physical possession of the liquid.
Right, they drive away with the oil.
Yep. That $50 is the spot price. It is the physical reality of the present moment.
But Wall Street doesn't make its billions dwelling in the present moment, does it? Wall Street is entirely focused on pricing the future.
Bingo. Which necessitates the futures price. A futures contract is a binding legal agreement. It obligates a buyer and a seller to exchange a specific amount of a commodity at a predetermined price on a specific delivery date.
So months or even years in the future.
Exactly. And this raises an important question about how the financial media shapes our perception of reality.
Oh, how so?
Well, when you turn on a news broadcast and the ticker at the bottom of the screen says, oil is trading at $80 a barrel, you naturally assume that is the price of a barrel of oil right this second.
Yeah, I think we all assume that.
But the market price quoted by the media is almost always the futures price. They are quoting a contract for delivery months down the line.
So if I'm understanding the mechanism correctly, buying a futures contract is basically like pre-ordering a highly anticipated video game or, say, a concert ticket for a huge artist going on tour next year.
That's a great analogy, yeah.
You buy the ticket today for $100. You are locking in that retail price right now to protect yourself because you know that in 6 months, the concert will sell out, the scalpers will flood the secondary market, and the price will probably skyrocket to $500.
Exactly. You are neutralizing the threat of future chaos by signing a binding contract today.
Wow.
You are legally fixing your future costs. And the existence of these contracts creates a massive global arena. We're talking major exchanges like the Chicago Mercantile Exchange, the London Metals Exchange, the Intercontinental Exchange.
Right, the big ones.
These exchanges are the battleground where two completely distinct types of players interact. And their daily tug of war is what ultimately determines the price of everything around us.
Okay, let's meet the players. Who is actually stepping into this arena?
So you have the hedgers and you have the speculators.
Okay, hedgers and speculators.
Right. Hedgers are the actual end users or the physical producers of the commodity. They are participating in the market purely to protect their real-world businesses from fatal price swings.
Give me an example.
Think of a soybean farmer in the Midwest. They've just planted thousands of acres of crops, taking on massive debt for seeds and fertilizer. But the harvest isn't for another 6 months.
And during those 6 months, anything could happen. A bumper crop in South America could suddenly flood the global market, making soybeans virtually worthless by the time our farmer's crop comes out of the ground.
Exactly. If the price crashes, the farmer goes bankrupt. So to survive, the farmer becomes a hedger. They go onto the Chicago Mercantile Exchange and they sell soybean futures contracts today at a price that guarantees them a small profit margin.
I see.
They are legally agreeing to deliver their soybeans in 6 months at today's price, effectively locking in their financial survival, regardless of what the market does between now and harvest time.
Okay, so the hedgers are the pragmatists. They are the farmers, the airlines buying jet fuel contracts so ticket prices don't fluctuate wildly, the coffee chains locking in bean prices. They are just using the market as an insurance policy.
Yep, it's pure risk management.
So who is taking the other side of that bet?
The speculators. These are the hedge funds, the institutional investors, the Wall Street traded...
Guys in the suits.
Exactly. They don't own farms. They don't refine oils. They are analyzing global weather patterns, supply chain bottlenecks, charting algorithms, all to guess which way the price is going to move. They enter the market purely to extract a profit from the volatility.
Here's where it gets really interesting, because the text points out the absurdity of this relationship.
It is pretty absurd.
Let's go back to that scenario I mentioned at the very beginning of the deep dive. We have a hotshot Wall Street speculator who buys a futures contract for 10,000 barrels of crude oil. They are just trying to make a quick buck on a price swing.
Right.
But a futures contract is a binding legal obligation to take physical delivery. How do they avoid waking up to a fleet of oil tankers idling outside their Manhattan apartment building?
Yeah, the physical logistics of that would be a nightmare. Taking delivery of a herd of live hogs or thousands of bushels of wheat is literally impossible for a financial firm.
Oh.
So the exchanges have specific mechanisms to prevent this.
Thank goodness for them.
Speculators avoid physical delivery by doing one of two things. They either roll over the contract, meaning they sell their expiring contract and buy a new one further out in the future, or the contract undergoes what's called cash settlement.
Cash settlement, meaning no physical stuff ever changes hands, just the difference in the monetary value.
Correct. When the contract expires, instead of delivering the oil, the buyer and seller just calculate the difference between the contract price and the current spot price and exchange the cash difference.
Oh, okay.
It allows speculators to trade millions of dollars of paper barrels without ever touching a drop of actual crude.
But I have to push back on this because the mechanics here are a little mind-bending to me.
Sure, go for it.
How does a hedge fund manager sitting in an office trading digital paper contracts that never result in a physical delivery actually change the real-world spot price that a farmer gets paid in Kansas? Aren't they operating in completely separate realities?
They seem separate, yeah, but they were intrinsically linked by a mechanism called price discovery, which requires massive amounts of liquidity.
Liquidity.
Imagine if only farmers and bakeries traded grain. There would be days when no one wanted to buy and days when everyone wanted to sell. The market would freeze up, prices would be incredibly erratic.
So the speculators act as the grease in the gears.
They provide the liquidity. Because Wall Street speculators are constantly buying and selling these paper contracts every second of the day, there is always a buyer and always a seller.
Oh, I see.
Their massive volume of paper trades absorbs the shock of real-world supply issues, creating a highly visible, continuous pricing mechanism that the entire globe looks at to determine what a commodity is currently worth.
Even if that speculator is taking a short position, which we should probably clarify for the
Oh,
listener.
got you.
A short position basically means a speculator is placing a massive bet that the price of the commodity is going to crash, right?
Yes. Taking a short position means the speculator borrows a contract, sells it at today's high price, and hopes to buy it back later at a lower price to return it, pocketing the difference.
Wait, shorting meaning Wall Street traders are literally making millions of dollars in profit when a farmer's crop loses its value?
Well, it sounds predatory when you phrase it that way.
It does.
But from a purely mechanical standpoint, short selling prevents price bubbles. If everyone could only bet on prices going up, commodities would become artificially expensive.
Okay, that makes sense.
Short sellers provide the downward pressure that keeps prices tethered to reality. The hedgers actually need the speculators to take on the risk they are trying to shed. It is a symbiotic relationship.
So, what does this all mean for you, the listener? We've explored how the hedge funds and the industrial farmers operate on a macroeconomic scale. But how does an everyday individual, say, someone saving for retirement, actually participate in this market?
Right, without taking on the terrifying risk of accidentally buying a futures contract and having to navigate cash settlements.
Exactly. We don't want any hogs in the living room.
It's a crucial question because you might already be participating without realizing it. The source text highlights that adding commodities to an investment portfolio provides vital diversification, particularly during times of extreme market stress.
Why is that?
Because when the traditional stock market is crashing, say, during a tech sector, meltdown commodities often hold their value or even rise. Why? Because regardless of how poorly a software company's stock is performing, human beings still need to consume food, burn energy, and build infrastructure.
The fundamental necessities don't care about a tech bubble popping.
Exactly.
But how do you get exposure to that without buying a silo to store wheat?
You utilize simpler, indirect mechanisms. First, you can buy stocks in commodity-focused companies. Instead of buying physical gold bars, you buy shares in a gold mining corporation.
Oh, clever.
Their stock price will generally rise and fall with the underlying price of the metal. Instead of trading crude oil futures, you invest in an energy exploration company.
So you let their corporate infrastructure do the heavy lifting of physical storage and futures hedging?
Precisely. And the text also points to commodity ETFs, or exchange-traded funds. These are incredibly popular mechanisms.
How do those work?
An ETF trades on the stock market just like shares of a regular company. But the fund's purpose is to track the price of a specific commodity, like silver or corn.
But wait, how does the ETF track the price of silver without building a massive vault to hold millions of ounces of physical silver?
Well, some ETFs do actually hold the physical metal in a vault. But many commodity ETFs, especially for things like oil or agriculture, track the price by buying those exact futures contracts we discussed earlier.
Oh, I see.
The managers of the ETF are the ones constantly buying contracts and rolling them over before expiration, so they never take physical delivery. You simply buy a share of the ETF, gaining exposure to the price movements, while the fund managers handle the complex mechanics of the futures market.
That is so much easier.
If we connect this to the bigger picture, having even a small piece of your retirement portfolio allocated to these foundational building blocks acts as a vital shock absorber.
A shock absorber for your wallet.
Exactly. When high-flying equities get chaotic, investments rooted in the unchangeable physical necessities of life provide a powerful financial anchor. You are anchoring your money to reality.
It fundamentally changes the way you look at the physical world around you. So just to recap the incredible journey we've been on today, we started with ancient merchants inventing risk management by bartering silks across deserts.
A long time ago.
We trace that exact same survival impulse all the way to high-speed digital exchanges in Chicago and London. We've seen how the invisible daily tug-of-war between pragmatic hedgers trying to protect their livelihoods, Wall Street speculators injecting liquidity, and the unpredictable chaos of Mother Nature all combine to dictate the spot price of today and the futures price of tomorrow.
It is a brilliantly designed, delicate ecosystem. But looking at the source text's emphasis on how severely weather impacts agricultural commodities, it leaves me with a rather provocative thought about the future of this architecture.
Oh, lay it on us.
The entire futures market was built on the assumption that extreme weather events, like a freak frost in Brazil or a devastating drought in the Midwest, were rare anomalies.
Right. Once-in-a-lifetime type things.
The speculators could absorb those rare shocks. But if we consider the increasing frequency of extreme climate events, How will that permanently alter the balance of power in this market?
Oh, wow.
If 100-year floods and super droughts become an annual occurrence, could the agricultural futures market eventually become too wildly volatile for speculators to confidently trade? And if the speculators leave the arena, destroying the liquidity, how will the global food supply function without that safety net?
That is a staggering realization. If the weather breaks the casino, the farmers have nowhere left to hedge their bets.
Exactly.
A heavy but absolutely necessary question to ponder. Because suddenly, that morning cup of coffee doesn't just taste like roasted beans. It tastes like global supply chains, ancient trade routes, and Wall Street liquidity all brewing in one single mug. Thank you so much for joining us on this deep dive into the hidden engine of our economy. We will see you next time.